Advanced Audit and Assurance, Chapter 8, Audit Evidence. Subtopic 2, Audit Documentation, ISA 230. Section 2.1, Audit Documentation, Audit Working Papers. All audit work must be properly documented and held in the audit file, also known as audit working papers. This documentation provides a record of the audit procedures performed, audit evidence obtained, and the conclusions reached. The documentation must provide a sufficient and appropriate record of the basis for the audit report and evidence that the audit was planned and performed in accordance with ISAs and applicable legal and regulatory requirements. ISA 230 requires the auditor to prepare documentation on a timely basis, sufficient to enable an experienced auditor with no previous connection with that audit to understand the nature, timing, and extent of the audit procedure performed, the result of those procedures and the audit evidence obtained, and significant matters which arose during the audit and the conclusions reached thereon. The auditor is also required to document discussions of all significant matters, how any inconsistencies with the final conclusion on significant matters were resolved, and justify any departure from a basic principle or relevant procedure specified by an ISA. Section 2.2, Reasons for preparing sufficient and appropriate audit documentation. Preparing sufficient and appropriate audit documentation on a timely basis helps to enhance the quality of the audit and facilitate the effective review and evaluation of the audit evidence obtained and conclusions reached before the audit report is finalized. Documentation prepared at the time the work is performed is likely to be more accurate than documentation prepared later. Other purposes of audit documentation include the following. 1. Assist the audit team to plan and perform the audit. 2. Assisting supervisors in directing and supervising audit work. 3. Ensuring members of the audit team are accountable for their work. 4. Keeping a record of matters of continuing significance to future audits. That is, keeping a record of matters of continuing significance to future audits. 5. Enabling an experienced auditor with no previous connection with that audit to conduct quality control reviews or other inspection, that is, by understanding the work that has been performed and the conclusions that have been reached. Section 2.3, Form, content, and extent of audit documentation. Audit documentation may be recorded on paper or on electronic or other media. The audit documentation for a specific engagement is assembled in an audit file. The precise content of the audit working papers varies, depending on the nature and size of the client and the complexity of the audit processes required to reach a conclusion, but will include 1. Audit programs, 2. Analysis, 3. Summaries of significant matters, 4. Letters of confirmation and representations, 5. Checklist, and 6. Correspondence. Traditionally, it has been normal practice to maintain two types of audit file, a permanent file and a current file. Permanent file. The permanent file records information that is likely to be of significance to every annual audit of that client. Examples of such information might include the following. 1. The legal constitution of the company. 2. Other important legal documents such as loan agreements, 3. A summary of the history, development, and ownership of the business. 4. A record of the accounting systems and procedures used by the client. 5. Copies of the financial statements for the previous years with key financial ratios and trends. This information is of continuing significance, and it is therefore important that the auditor should review the content of the permanent file regularly and update it as appropriate. Current file. The current file contains information of relevance to the current year's audit. This will be the main evidence on which the conclusion for the current audit will be based. Examples of the content of a current audit file include the following. 1. The final financial statement and auditor's report. 2. A summary of audit adjustments, including those not included in the final reported figures. 3. Audit planning documentation. 4. Audit control material, such as time budget, review points, points for consideration by the engagement partner. 5. Audit letters. 6. For each audit area, such as inventory, sales, and payroll, an audit plan detailing the work to be done on that area, details of items selected for testing, the test performed, problems that were encountered, and how these problems were solved, and the conclusion reached by the auditor on that area of operations, the financial statement. Lead schedules. These give the figures for the audit area that will appear in the final financial statement. All audit working papers should clearly show the following and for each audit area as appropriate. 1. The name of the client. 2. The accounting date. 3. A file reference. 4. The name of the person preparing the working paper. 5. The date the paper was prepared. 6. The name of any person reviewing the work and the extent of such review. 7. The date of the review. 8. A key to or explanation of the audit ticks or symbols used in the working paper. 9. A listing of any errors or omissions identified. 10. The auditor's conclusion on the area. ISA 230 requires the auditor to assemble the final audit files on a timely basis after the audit of the audit. ISA 230 requires the auditor to assemble the final audit file on a timely basis after the date of the audit report, ordinarily not more than 60 days. This usually excludes drafts of working papers of financial statements or notes that reflect incomplete or preliminary thinking. After the assembly of the final audit file has been completed, the auditor must not delete or discard audit documentation before the end of its retention period. If it does become necessary to modify existing or add new documentation after this stage, the auditor must document when and by whom the modifications were made, the reasons for making them. If exceptional circumstances arise after the date of the audit report, such that the auditor has to perform new or additional procedures or reaches new conclusions, the auditor must document the circumstances, the new or additional procedures performed, audit evidence obtained, conclusions reached, and their effects on the auditor's report, and when and by whom the resulting changes to audit documentation were made and who reviewed them. Section 2.4. Computer-generated audit working papers. Auditors often use computer software with laptop computers to improve the efficiency of preparing audit working papers. These software packages can be used to help the auditor to prepare analysis schedule, especially where the audit firm uses standardized working paper, lead schedules, and draft financial statements. These schedules and statements can usually be cross-referenced and updated automatically as the audit proceeds. To allow for adjustments that the auditor makes, the advantages of these computer software packages for auditor are as follows. 1. The working papers are neat, easy to read, and in a standard format. 2. There is a lower risk of error by the auditor in processing adjustments. 3. The audit review process by senior managers or the audit partner can be carried out remotely without the necessity for the manager or partner to visit the client's premises to carry out the review. The automatic processing of adjustments by the auditor using software may result in significant savings in time and cost. Section 2.5. Ownership, custody, and confidentiality of audit working papers. The audit firm has ownership of the audit working papers. The papers are not a part of the client's accounting records and do not belong to the client. The auditor needs to decide how long to keep the audit files. ISQC 1 requires a minimum period of 5 years from the date of the audit report or group audit reports if later and relevant. Auditing standards require the auditor to ensure that working papers are kept safe and that their contents are kept confidential. Confidential information should only be made available to third parties in accordance with ethical guidelines. Subtopic 3. Related parties. ISA 550. Section 3.1. Related parties and related party transactions. Related parties are individuals or organizations that might have or might be expected to have an undue influence on the company that is being audited. Examples of related parties include 1. The directors and key management of a company. 2. Their families. 3. Other companies controlled by directors, key managers, and members of their close family. 4. Other companies in the same group. Related party transactions are material transactions between the client's company and a related party of the company. It is the responsibility of the client's company's management to record and disclose all material related party transactions, because these transactions may be carried out on more favorable terms than similar transactions with an independent third party. The approach required by IAS 24 related party disclosures is to disclose the relevant amount of related party transactions and the nature of the related party relationships, so that the users of the financial statement can decide for themselves whether these transactions might have resulted in a manipulation or distortion of the financial statement. ISA 550 related party deals with the auditor's responsibility in respect of related party transactions. It was revised and redrafted in July 2008 for two main reasons. 1. The increased public attention given to accounting for related party relationships, because a number of major corporate scandals, such as Enron in the US, have involved related parties. 2. The previous version of ISA 550 was mainly procedural in nature and did not discuss the risk of material misstatements that may arise from the existence of related party relationships and transactions. The requirements of ISA 550 are discussed below. Section 3.2. The impact on the audit of related party relationships and transactions. Although many related party transactions are in the normal course of business and therefore may carry no higher a risk of material misstatement than ordinary transactions, in some circumstances, related party transactions may lead to higher risk. For example, 1. Related parties may operate through complex structures and relationships, and the resulting transactions may therefore also be complex. 2. Accounting systems may not be effective at identifying and summarizing related party transactions and balances. 3. Related party transactions may not be conducted on normal market terms. Some may even be conducted with nil consideration. The objectives of the auditor with regards to ISA 550 are to obtain 1. An understanding of the entity's related party relationships and transactions, and 2. Sufficient appropriate audit evidence about whether related party relationships and transactions have been appropriately identified, accounted for, and disclosed in the financial statement. The understanding must be sufficient for the auditor to be able to 1. Recognize fraud risk factors arising from related party relationships and transactions. 2. Conclude whether the financial statement achieves fair presentation in respect of related party relationships and transactions. There is an increased risk of fraud in this area, as related party relationships may present a greater opportunity for collusion, concealment, or manipulation by management. It is therefore particularly important that the auditor approaches this area of the audit with professional skepticism. Section 3.3. The requirements of ISA 550. Most material misstatements linked to related party transactions arise from failure by the management of the client company to disclose related party transactions and relationships to the auditor. ISA 550 therefore sets out a minimum set of risk assessment procedures specifically directed towards the identification of related party relationships and transactions that have not been identified or disclosed by management. Risk assessment procedures. As part of the risk assessment procedures required by ISAs 240 and 315, the auditor is required to perform the following procedures in order to understand the entity's related party relationships and transactions. 1. Consider the risk of material misstatement due to fraud or error arising from related party relationships and transactions. 2. Make inquiries of management in respect of the identity of related parties, the nature of relationship with those related parties, the nature of any transactions entered into with those parties during the period. 3. Obtain an understanding of the internal controls in operation over the identification of, accounting for, and disclosure of related party relationships and transactions, the authorization and approval of significant related party transactions, the authorization and approval of significant transactions outside the normal course of business, identifying related parties and related party transactions. In making inquiries of management in respect of the identity of related parties, the auditor will obtain a list of related parties from the directors and consider if this list is complete. Tests for completeness could include the following. 1. Review working papers for previous years to look for names of known related party. 2. Review the company's procedures for identifying related party. 3. Inquire about the relationships between directors and other entities. For example, Does any director own another company? And have there been any transaction between that company and the client company? 4. Review shareholders' record for the names of major shareholders. 5. Review minutes of shareholders' meeting, general meetings of the company. 6. Ask any other audit firms involved in the audit about related parties. If the audit is the audit of a group of companies and more than one firm of auditors is involved. Or ask previous auditors of the company about their knowledge of related parties. The auditor may have difficulty in obtaining a complete list of related parties. This is because their main source of information about related party is the client management, who may wish to keep related party relationships hidden. Particular problem areas where the disclosure of related party may be incomplete are 1. Close family relationships. 2. Where the related party is another business entity which is owned or influenced by a director of the client company. However, two companies are not necessarily related parties just because the same individual is a director or shareholder in both. The key issue is whether the individual is in a position of influence in both companies. The auditor may also have difficulty in identifying all related party transactions that have occurred, unless the client entity has recorded them separately. Related party transactions may be hidden within all the other transactions recorded in the account of the entity. During the audit, the auditor must remain alert when inspecting records or documents for information which might indicate the existence of previously unidentified or undisclosed related party relationships or related party transactions. The auditor is also specifically required to inspect the following: 1. Any bank and legal confirmations obtained as part of his audit work. 2. Minutes of shareholder and management meeting. 3. Any other records or documents the auditor considers necessary in the specific circumstances. If the auditor identifies significant transactions outside the entity's normal course of business, he must inquire as to the nature of these transactions and whether related party could be involved. This is because these carry a higher risk of involving related party who have previously been unidentified or undisclosed. ISA 550 states that any significant related party transactions outside the entity's normal course of business must be treated as giving rise to significant risk of material misstatement. The whole audit team should be made aware of information obtained about the entity's related party so that they can identify any previously undisclosed transactions with related parties. If any fraud risk factors are found, this must be taken into account when the auditor identifies and assesses the risk of material misstatement due to fraud in accordance with ISA 240. A key fraud risk factor identified by ISA 550 is the existence of a party who exerts dominant influence over the entity. Any such parties is likely to be able to override the views of the entity's management and force the entity to enter into a transaction in which the dominant party has an interest. Indicators that a person or entity might be a dominant party include: 1. The party vetoing significant business decisions of the entity. 2. Significant transactions being referred to the party for final approval. 3. Little or no debate among management in respect of business proposals made by the party. 4. Transactions involving the party or its close family members are rarely independently reviewed or approved. Responses to the risk of material misstatement. As discussed in a previous chapter, the auditor is required by ISA 330 to respond to assessed risk. In the context of the assessed risk of material misstatement arising from related party relationships and transactions, ISA 550 requires the following audit procedures. If the auditor discovers previously unidentified or undisclosed related party or related party transactions, he must 1. Determine whether the underlying circumstances confirm the existence of those relationships or transactions. 2. Communicate the relevant information to the audit team. 3. Request management to identify all transactions with the newly identified related parties. 4. Inquire as to why the entity's system failed to identify or disclose these related party relationships or transactions. 5. Perform appropriate substantive procedures on the newly identified related parties or significant related party transactions. 6. Reconsider the risk of there being unidentified or undisclosed related parties or significant related party transactions and perform additional procedures as necessary. 7. If the non-disclosure appears intentional, evaluate the implications for the audit. If the auditor discovers significant related party transactions outside the entity's normal course of business, he must 1. Inspect the underlying contract or agreement to evaluate whether the contracts were entered into in order to engage in fraudulent financial reporting or to hide the misappropriation of assets. The terms of the contract are consistent with management explanation and the transactions have been properly accounted for and disclosed. 2. Obtain evidence that the transactions were properly authorized. If management has made a statement in the notes to the financial statement that a related party transaction was made on the same terms as an arm's length transaction, the auditor must obtain evidence to support his assertion. Materiality of related party transactions. ISA 450, Evaluation of misstatements identified during the audit, which is covered in a later chapter, requires the auditor to consider both the size and the nature of a misstatement and the particular circumstances of its occurrence when evaluating whether a misstatement is material. In the context of related party transactions, this means that much smaller transactions in monetary terms may be material, as the significance of the transaction to the users of the financial statement may not depend solely on the recorded amount of the transaction, but also on the nature of the related party relationship. It may be tempting to assume that materiality means large, but in the case of related party transactions, a transaction could be material if it has a value as low as €0. For example, a transaction involving the sale of company's assets to a related party for a very low price. Other requirements. Written representations must always be obtained by the auditor from the directors about related parties and related party transactions. The directors are in the best position to know the identities of any related parties. The written representation from the director must cover 1. The completeness of the information that has been provided about the identity of related parties and related party relationship and transactions, and 2. The adequacy of accounting for and disclosure of such related party relationships and transactions in the financial statements. Unless all of those charged with governance are involved in managing the entity, the auditor must communicate to those charged with governance significant matters arising during the audit in connection with the entity's related parties. The names of all identified related parties and the nature of the related party relationships must be documented. Example: audit matter and audit evidence. The draft statement of financial position of ABC Company includes an amount of 30,000 naira owed by DE Company. The total assets of ABC Company are 20 million. The auditor has obtained the following audit evidence. 1. DE Company is controlled by the chairman of ABC Company, who is its majority shareholder. 2. The draft financial statements of ABC Company do not provide any disclosure about the 30,000 naira transaction on the ground that it is immaterial. 3. There is no information about the nature of the transaction, but the 30,000 naira had been included in receivables at the end of the previous financial year. Required: what further measures should the auditor take? Answer: the auditor should first establish whether DE Company is a related party of ABC Company. From the information available, it will seem that it is a related party because the chairman of ABC Company, as a majority shareholder in DE Company, would appear to be in a position of influence in both companies. Although the amount receivable is not material in terms of value in relation to the value of total assets of ABC, the materiality of related party transactions should not be judged only on the basis of value. The nature of the transaction is also relevant for judging materiality. The auditor needs to obtain more information. The chairman should be asked to provide more details. In addition, the auditor should review the written terms of the transactions, if there are any, and should obtain a written representation from the chairman about the nature of his influence over DE Company, whether the amount receivable by ABC Company is likely to be recoverable, and when it is likely to be paid. The auditor should also review board minutes of ABC Company for any recorded discussions by the board of the transactions with the company. If the auditor takes the view that the transaction is a related party transaction, it should notify management of the need for disclosure in the financial statement. Disclosures is required of the nature and amount of the transaction, the amount of any balances, and any allowances that have been made for an irrecoverable amount. Since the amount was receivable 1 year ago, the auditor should also consider the expected date of payment and whether the balance is more in the nature of a long-term loan receivable than a current asset. Subtopic 4. Written representations. ISA 580. Section 4.1. Definition and objectives. ISA 580 defines a written representation as a written statement by management provided to confirm certain matters or to support other audit evidence. The objective of the auditor in this area per ISA 580 are to 1. Obtain written representations from management that it has fulfilled its responsibilities in respect of the financial statement and the audit. 2. Obtain written representation as appropriate to support other audit evidence. 3. Respond appropriately to written representation provided by management, or if management refuses to provide the written representation requested. ISA 580 requires the auditor to obtain appropriate written representation from management, often referred to as management representation, in the form of a letter of representation addressed to the auditor. These written representations may be an important source of audit evidence. Section 4.2. Written representation as audit evidence. If the auditor considers that written representation are needed to support other audit evidence, he must request such other written representations. During the course of the audit, management will make many representations to the auditor. Some of these will be unsolicited, but some will be given in response to specific inquiries from the auditor. The auditor will have recorded such verbal discussions with management in the audit working papers. However, verbal evidence is not strong audit evidence. In order to improve the quality of this evidence, the auditor will ask for any significant discussions to be confirmed in writing. Such representations are likely to be needed. 1. To support the auditor's understanding of management intention or judgment. For example, in respect of future plans for the business or a specific matter such as the net realizable value of inventory. Or 2. In respect of the completeness of a specific item. For example, that all liabilities have been provided for. However, although such written representations provide necessary audit evidence, they do not provide sufficient appropriate evidence on their own. It is if a written representation is contradicted by other audit evidence, the auditor should 1. Consider whether his risk assessment of that area is still appropriate. 2. Consider whether additional audit procedures are needed. 3. If he has concerns about the integrity of management, document those concerns and consider withdrawing from the audit. The auditor is also required by specific order ISAs to request certain other written representations. These requirements are illustrated in the example letter set out below. Section 4.3. Written representations about management responsibilities. The auditor is also required by ISA 580 to obtain certain other written representations from management. In this representation, management acknowledges that 1. It has fulfilled its responsibility for the preparation and fair presentation of the financial statement in accordance with the applicable financial reporting framework. 2. It has provided the auditor with all relevant information. 3. All transactions have been recorded and are reflected in the financial statement. Again, these points are illustrated in the example letter set out below. Section 4.4. Form and content of the letter of representation. The letter of representation is usually drafted by the auditor, as he knows the areas on which he requires written representations, addressed to the auditor, dated as near as practicable, but not after the date of the audit report. The following example of a letter of representation shows the minimum content of such a letter. However, remember that the auditor may also need to request management to provide written representations about specific assertions in the financial statement. Example of a letter of representation. Entity's letterhead to auditor, date. This representation letter is provided in connection with your audit of the financial statement of ABC Limited for the year ended 31 December 20X1 for the purpose of expressing an opinion as to whether the financial statements are presented fairly in all material respects or give a true and fair view in accordance with international financial reporting standards. We confirm that, to the best of our knowledge and belief, having made such inquiries as we considered necessary for the purpose of appropriately informing ourselves. Financial statements. We have fulfilled our responsibilities for the preparation and presentation of the financial statement as set out in the terms of the audit engagement dated ... And in particular, the financial statements are fairly presented or give a true and fair view in accordance with international financial reporting standards. Significant assumptions used by us in making accounting estimates, including those measured at fair value, are reasonable. ISA 540. Related party relationships and transactions have been appropriately accounted for and disclosed in accordance with the requirements of international financial reporting standards. ISA 550. All events subsequent to the date of the financial statement and for which international financial reporting standards requires adjustment or disclosure have been adjusted or disclosed. ISA 560. The effects of uncorrected misstatements are immaterial, both individually and in aggregate, to the financial statement as a whole. A list of the uncorrected misstatements is attached to the representation letter. ISA 450. Information provided. We have provided you with 1. All information, such as records and documentation, and other matters that are relevant to the preparation and presentation of the financial statement. 2. Additional information that you have requested from us, and 3. Unrestricted access to those within the entity. All transactions have been recorded in the accounting records and are reflected in the financial statement. We have disclosed to you the results of our assessment of the risk that the financial statement may be materially misstated as a result of fraud. ISA 240. We have disclosed to you all information in relation to fraud or suspected fraud that we are aware of, and that affects the entity and involves management, employees who have significant role in internal control, or others where the fraud could have a material effect on financial statements. ISA 240. We have disclosed to you all information in relation to allegations of fraud or suspected fraud affecting the entity's financial statements communicated by employees, former employees, analysts, regulators, or others. ISA 240. We have disclosed to you all known instances of non-compliance or suspected non-compliance with laws and regulations whose effects should be considered when preparing financial statements. We have disclosed to you the identity of the entity's related parties and all related party relationships and transactions of which we are aware. ISA 550. Section 4.5. Refusal to provide requested written representation. If management refuses to provide requested written representation, the auditor must 1. Discuss the matter with management, 2. Re-evaluate the integrity of management and consider the impact on other representations and audit evidence. And 3. Take appropriate action, including considering the effect on the audit report. Subtopic 5. Using the work of an auditor's expert, ISA 620. Section 5.1. Definition of an expert. Definition: auditor's expert. The term expert is used here in the sense of an individual or an organization that possesses skills, knowledge, and experience in field other than accounting or auditing. The auditor may use the work of an expert to provide knowledge relevant to the audit, which the audit firm itself does not possess. ISA 620, using the work of an auditor's expert, give a number of examples where experts may be used by an auditor. These include legal opinions, specialist valuation areas such as property or pension liabilities, the analysis of complex or unusual tax compliance issues. Note that the ISA covers the work of the auditor's expert. The expert is employed by the auditor, not by the entity. The situation where management used the work of an expert was covered above under ISA 500. The objective of ISA 620 is to allow the auditor to decide whether to use the work of an expert and assess whether that work is adequate. Section 5.2. Assessing the need for an expert. There is a cost attached to the use of an expert by the auditors. The expert will charge a fee for the professional service he provides. The use of an expert should therefore be evaluated on a cost-benefit basis. When deciding whether he needs to use an expert to assist him in obtaining sufficient appropriate evidence, the auditor should consider such factors as 1. The nature, significance, and complexity of the matter. 2. The risk of material misstatement. 3. The availability of alternative sources of audit evidence. Section 5.3. Assessing the work of an expert. ISA 620 requires the auditor to apply the procedures set out below when using the work of an expert. The auditor shall 1. Obtain an understanding of the expert's field of expertise, sufficient to allow the auditor to determine the nature, scope, and objectives of the expert's work and evaluate the adequacy of that work. 2. Agree terms of engagement with the expert, including the nature, scope, and objectives of the expert's work, the respective responsibility of the expert and the auditor, the form of the expert's report, confidentiality requirements. 3. Evaluate the adequacy of the expert's work, including the reasonableness of the expert's conclusions, consistency of those conclusions with other audit evidence, reasonableness of significant assumptions and methods used, relevance, completeness, and accuracy of source data. Generally, the auditor is assessing whether the expert's work constitutes sufficient and appropriate audit evidence. If the auditor decides that the work of the expert is not adequate, he is required to 1. Agree additional work with the expert, or 2. Perform other appropriate additional audit procedures. The auditor has sole responsibility for the audit opinion issued, and this is not reduced in any way by his use of an expert. Therefore, he should not refer in his report to the use of an expert, unless that is required by law or regulation. Even then, or if the auditor refers to the expert's work in his report because it is relevant to an understanding of a modified opinion, then he must make it clear that such a reference does not reduce his responsibility for that opinion in any way. This approach reinforces the point made earlier that the auditor remains fully responsible for the reports produced, even if evidence on which it is based was produced by others. The auditor therefore cannot simply accept work performed by experts. That work must be evaluated in the same way as other audit evidence is evaluated. The competence, capabilities, and objectivity of an expert may be assessed in one or more of the following ways. 1. Personal experience with previous work of that expert. 2. Discussion with that expert. 3. Discussions with other auditors or others who are familiar with that expert's work. 4. Knowledge of that expert's qualification, membership of a professional body or industry association, license to practice, or other form of external recognition. 5. Published papers or books written by that expert. The objectivity of the expert The objectivity of the expert is probably more of an issue when the expert has been employed by the audit client, as discussed earlier in this chapter in section 1.2 regarding using the work of management experts.